Welcome to Excess Returns, where we focus on what works over the long term in the markets. Join us as we talk about the strategies and tactics that can help you become a better long-term investor.
Jack Forehand is a principal at Validia Capital Management. The opinions expressed in this podcast do not necessarily reflect the opinions of Validia Capital. No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of Validia Capital.
Hey guys, this is Justin. In this episode of Excess Returns, Jack sits down with DampedSpring founder Andy Constan. Andy is one of our favorite guests because he always offers a balanced view and uses a very thoughtful approach to analyze markets. With everything going on in the macro world and the recent volatility in markets, it was a perfect time to have Andy back to help us make sense of it all. Jack and Andy discuss the recent market decline and the driving forces behind it, the recent jobs report, the outlook for inflation, and a lot more. Andy's unique perspective on the macro world was in full display during this interview, and we hope you learn as much from it as we did. As always, thank you for listening. Please enjoy this discussion with Andy Constan.
Andy, thank you for coming back on.
Pleasure to be here, Jack. As
I
always.
think it's your fifth appearance on Excess Returns, I believe. So we appreciate you continuing to say yes when I continue to email you about it.
Fantastic. I always enjoy the conversations.
So we're going to cover a lot today. We're going to cover inflation. We're going to cover the economy. We're going to cover what's going on with the Fed. But I want to start out with what happened recently, because what happened last Monday was a very interesting event in that we hadn't seen something like that in a long time. And there's been a lot of people out there trying to explain what went on and what's going on behind the scenes and whether it's going to continue and a lot of things. So I wanted to just start by getting your take on that. Like, what was your take on what happened last Monday and what's going on behind the scenes in the market?
Yeah, I mean, I think you have to step back and say that Monday was just an outcome of what had been set up. And I think that basically is a classic deleveraging that occurs periodically across markets. I just wrote a DampedSpring report that profiles about 13 of them. And it's fairly classic. They all start with a system that is, for whatever reason, a little over its skis in terms of leverage. It could be a lot over its skis. It could be the whole financial system is over-levered, or a single investor. And whenever that happens, whenever there is leverage in the system, there are a couple of things that can happen. I guess the first thing that people are focused on, which I think is missing the point quite a bit, is the cost of your borrowing can go up. Meaning, if you're borrowing at a floating rate and buying long-term assets with it, you're exposed to your cost of carry, which is the interest you pay every day to maintain your leverage. And so rate hikes increase that leverage. The problem is they work so slowly. If you're paying 10 basis points in yen carry and they move it to 25 basis points, that's 1/365th of 15 basis points per day that the trade begins to cost you. So that's not really a motivation to unwind. Typically, leverage is unwound when there is a lender who needs more collateral. You put 100 cents on the dollar. You buy 100 cents worth of NVIDIA stock. Your margin clerk posts 70 cents and you post 30. And they want more money when the equity value, if it goes to 90 and your equity value is now only 20, they're going to want $7. And if you don't post that money, they're going to liquidate you. And that's a margin call. And you notice what it starts with is the lender was perfectly happy to lend you money. They weren't asking for it back. But the asset price fell. And so I think you have to always think about a deleveraging from what's happening to asset prices, whether it's homes in 2007, the Thai baht in 1997, long-term interest rates in 1994. You pick them, you're going to find most deleveragings occur when the thing that's being leveraged falls. Japan and the Japanese carry trade is just the same as that, except you have to add another potential catalyst for a forced unwind. Certainly the asset price falls. So if you bought NVIDIA on leverage and the asset price falls, you may need to sell. Alternatively, on top of that, if you bought NVIDIA on leverage and you borrowed the money, the dollars that you needed from denominated in yen, then you also have the potential that when you go to sell, that you need to come up with even more money to, if the yen has appreciated, to pay back the yen you'll need. And so the yen carry trade is just another form of a leveraged unwind, where both, in this case, both the asset and the denomination of the loan went against you. And so, that creates extra selling or more sensitive, more losses from levered positions. And so I think that's happening. I think the yen has appreciated. That's certainly clear, which indicates that people who are borrowing yen are chasing to buy back the yen they are short and deliver it to the people that they borrowed from. But also mostly it's about asset prices falling.
How do these carry trades work in the real world? I mean, is it mostly people borrowing in yen and then buying something like low risk, like T-bills? Or is this a lot of like people borrowing yen and then they buy risky assets?
Yeah, I mean, I think you have to step back again and say, there's some literal people that borrow yen and invest and buy on leverage some other asset as a carry trade. And then there's the Japanese in total, which have $3.5 trillion worth of market value of rest of the world portfolios. And so they have either bought hard assets like real estate, bought financial assets like stocks, or lent money to the rest of the world in a total of around $3.5 trillion. And so that's all the lending that's going out to foreigners. So that's a good ballpark quantity. But most of the lending is not for speculative trades like you're describing. It's for, longer term lending, and the Japanese themselves are buying assets. So I don't think the literal people that are borrowing in yen and buying something else are anywhere near the size that most people have said. But the typical trade, and this is probably one of the first canaries in the coal mine, is a carry trade across currencies. And so one of the classic ones that has been working so well has been borrowing in yen and investing in the Mexican peso. And that one really started to unwind right after the election in Mexico. And in that case, you're buying a T-bill. They're buying short-term paper in Mexico that pays a high interest rate denominated in pesos. The peso is appreciating relative to the yen, and the cost of interest on the yen loan is small. And so that's the carry trade. Now, you can buy any asset, and people buy all sorts of assets, but, that's one of them.
So when we think about what happened Monday, I mean, I think from what you're saying, you don't believe the yen carry trade was the cause of what happened Monday, but we'll always, all the news will always be telling us it was this or it was this or it was this. Like, what do you think when you look at something that happens like that, that's maybe not a major decline in the long term, but something investors are definitely worried about because it's something that kind of came out of nowhere. How do you think about analyzing what went on?
Right. So that's the big question. I don't know the answer, whether the deleveraging that occurred over the last, call it month, sort of since July 11th, stocks, risky assets have fallen. Short-term interest rates have risen a lot. The yen has appreciated a lot. And other things that are measures of deleveraging have occurred, like high volatility, credit spreads expanding. It's clear a deleveraging is going on. The question that everyone wants to know, because, the buy the dip culture in the world is very strong and very successful, is when is it over? And so I just look at a framework for that. I don't, try to guess. Let me just be clear. No one knows. There are people that are saying it's 75% over. JP Morgan recently printed something about that. Everybody is guessing. No one knows. So the question is, what do you want to know about deleveragings that can give you some information that makes it and signs that it is in fact over? And so this is what my DampedSpring report is about. And I'll just give you the high level, it's for clients. So I'll give you the high level framework, which is who's selling. That's an important piece of the information. Is it one guy, like in 1997, where a 15% drawdown occurred because one guy was forced out of his puts because he was exposed to Thai baht stocks? It doesn't seem like that here. Is it systemic? That's the other extreme, in which dealers, banks, insurance schemes are being forced to unwind in large quantities. There's no sign of that, as far as I can tell. And so it falls somewhere in the middle. And I would describe the sell-off as broad across many assets and impacting many different types of investors. And when I step back and say, prior to the deleveraging, what did I think the environment looked like? I would say the following, which is assets were very well bid up. There was an expectation that the central banks were on an easing path, that, even still earnings expectations were extremely high for the next 2 years. Multiples were very high. Fixed income risk premium was very low. Vol was very low. And all of those things are consistent with investors at a fairly high level of leverage. And you can look at other forms of leverage, how much repo is being done, what is the cost of repo that's seen in swap spreads. So how much demand for leverage is there? Margin loans, existing margin loans. And what I would have described, and what I have been describing, is that the system's pretty leveraged and asset prices are not very attractive. And so that's a good circumstance for a broad deleveraging. And I'm not talking about a stock market crash. I'm just talking about, let's get some of the leverage out. And it's important to note that it's not like when the system is leveraged, say the overall system is leveraged 2 to 1. And there's a deleveraging. A new investor that is buying the positions that are being sold needs to lever. And they're not going to lever 2 to 1. If so, the market's price isn't going to change. They're going to want to lever, 1.5 to 1. And the only way to get that, meaning the leverage gets paid back by one and new leverage is created by another, the only way to deal with that is a price decline. And so, I'm just talking about a classic deleveraging correction. We saw it in 2018 when the Fed was too tight. We saw it in 2022 when in the midst of the market sell-off, when the UK LDI scheme unwound. We saw it in the SVB situation. So those are recent cases, and obviously we saw versions of that throughout history. And so that's what's happening. The next bit so that's who's selling and why. And the answer is broad, and asset prices are not particularly attractive. And there's a high amount of leverage in the system. So that's who's selling. That tends to mean that it lasts longer than if one or a few people are being delevered, like Bill Huang, or Victor Niederhofer, or some of these other cases where it was very narrow deleveraging. So it's broad, and that's the first part of the framework. The second part is, how are financial institutions doing? Because there's only been one major situation where the financial system had all of the same positions as the private sector, and they were forced to delever and they were unable to offer credit. In fact, they had to take away credit from their existing clients. And that was the GFC. Now, there have been other times where, for whatever reason, these banks are either in the same position, 1998 is a fairly good example of that, or are constrained in some way in terms of how much leverage they can have, but they're not contributing. So that's a metric. How are financial institutions? And the better shape they are and the least exposed they are to the deleveraging, the shallower it's going to be, and the shorter it's going to last. And right now, they're in great shape. So that would be a signal that would be a circumstance where one would expect a deleveraging to be shallower and quicker. And then you have the impact on the economy. And, when you look at deleveragings, whether it's 2000 or 1998 or COVID or the ones that didn't have impact on the economy, some of these deleveragings can be causal to a economic slowdown. And, that has an impact on when there is an economic slowdown that is caused by the deleveraging, it takes a long time for the bottom to be in a deleveraging. And then the last thing is, what do the central banks do? What do policymakers do? And, now we're in a world in which part of the policy making can be fiscal spending, which we saw in COVID, and to a little medium extent what we saw in the SVB crisis. Whether the central bank or fiscal does anything is an important criteria in terms of whether there's going to be a bounce. The strength of their response will obviously have a meaningful impact on those things. If you look at the COVID crisis, which, is exogenous, the market corrected in 1 month, made its low in 1 month, and I think it was 120 days later was back to its all-time high. That's because of the strength of the response. And so it's super important to judge whether this will elicit whether it'll affect the economy and whether it'll elicit a Fed reaction. And, Jeremy Siegel called for 75 basis points cuts on Monday. That was an incredibly stupid thing to say, emergency cuts. He since retracted that as the market stopped panicking. But it's interesting to note that in 1987 and in the long-term capital crisis, the entire cuts that occurred in the greatest stock market crash in history and the biggest hedge fund unwind in history, in which equities fell 20% in 2 months, the Fed cut 75 basis points in total. So you have to judge whether there's going to be a bazooka-like response. I would just look at the SVB crisis, and it was short and sweet because the response was over the top. Whereas I'd look at but it was a meaningful event. I'd look at the LDI crisis and say, the BOE had a rifle shot right to where it was needed. They bought some bonds back. They redid QE. But immediately after, and that solved the problem. Now, of course, trust being kicked out really was the problem. But from a financial standpoint, that problem was solved very quickly. And then the stimulus was removed, whereas in the SVB crisis, we're still living with the $106 billion worth of BTFP that doesn't expire for another year. And so that's easier than, and probably disproportionate to what was happening back then. So anyway, that's the overall framework. 4 pillars: who's selling, how the bank's doing, what's the economy going to do, and what are the central bankers going to do? And you have to judge for yourself where we are in that framework and what the likely outcome will be.
I want to ask you more about some of the stuff you said about the economy, but first I want to ask you about the VIX, because people like me are kind of outside of that world, and your average investor too saw a huge spike in the VIX to, in theory at least, over 60 on Monday. And we're worried about, is there something going on? Because if you look at previous episodes where the VIX spiked to 60, there was a major event tied to it. And someone had a chart going around on Twitter with this, like all these major events. And then this one, which seemed like it wasn't tied to much of anything, and the VIX went above 60. So what do you make of that?
Well, I am willing to get technical about it, but I don't know whether it's useful. I'll start with the following. The VIX is a calculation. It represents the prices of a series of options that expire within the next month. And those options change through time, meaning it's not the same option every day. Each day there's a new option, well, each period of time, every few days, there's a new option that comes on that's included in the calculation. And it's lots of options. It's not just one, it's a series of options. And it's a calculation. And it's not tradable. There are no products that can trade the VIX, except VIX options, which are even harder to necessarily explain to your viewers. What does trade, and so represents the true expectations for vol, is VIX futures. And those didn't spike. They went up a lot. They went up to 35, if I'm not mistaken. But they didn't spike anywhere near what the VIX did. Why did the VIX spike? There are people, Dean Kernett, who runs Alpha Exchange, who's a phenomenal derivatives person, did an analysis of every single thing that was used in the calculation for the VIX at that time, and found an option that was the most meaningful contributor to that calculation for that at that moment, that was clearly mispriced relative to any other option. And so what does it mean to be mispriced? Well, every moment that these calculations are done, someone is bidding and someone is offering, and they take the mid price of that, and that's what they do. Now, I don't know if you or any of your viewers tried to trade options on Monday, but the bid offer spreads were astoundingly large. Now, does that mean the mid is accurate? It could conceptually, the bid offer spread could be, perfectly wide around the mid being the price, but it's unlikely that that's true. And so the price that was used that generated a 65 VIX was simply not an accurate price, not something that could have been traded at, was not the mid market of what could have been traded. And so, but that's the calculation. They follow the rules, and the VIX printed 65. That's true. But so what? You couldn't trade it. Nothing priced off of that thing. It was just a signal that people and mainstream media puts on the front page, and then you see those charts and all those sort of things. But if you look at the VIX, the VIX futures, which have traded for a long time as well, in none of those events that, this was, I think it was two events, the 2020 and 2000 and GFC and COVID, where the VIX had spiked to this level. And then this one. The VIX futures spiked like on those two, crazy days, crazy periods. But the VIX futures really didn't do anything. It moved a lot, but it wasn't unusually large. And so I guess what I would say to your viewers is, particularly on days like that, it's better to use things that are actively trading that represent what you care about, which is, is the fear gauge triggering?
You mentioned the wide option spread on Monday, and that gets at an issue a lot of people are worried about right now, which is you'll hear all the time on Twitter, liquidity beneath the surface is horrible. And so people worry, well, if we had an event like this and we had what we had, what happens if we have a major event? Is that something you're concerned about, that liquidity is drying up or it's very bad beneath the surface?
the way I think about liquidity is probably different than most that are discussing it in the way you just did. Liquidity to me is when it is what is necessary for a meaningful player to move a meaningful amount of risk, and what sort of impact are they going to have? And they're dealing with, in doing that, they're dealing with large scale liquidity providers and large scale potential counterparties who are taking the opposite side of their trade. And so, that's when I think about liquidity. And now that isn't perfect either. And, you should expect some high costs in trading during times of stress if you're moving large amounts of risk. But I think what most people are talking about is very short-term liquidity for a relatively small size, like, your viewers are probably transacting in. And I actually am pretty optimistic about liquidity most of the time. Compared to, years past, the cost of trading is extraordinarily low for everyone. And, that's a good thing. But it's also true that trading during a period of time when big participants are moving risk or there's great uncertainty is always much, much more expensive. And I just discourage it. I just would, my thinking generally about trading in general and investing in particular is you shouldn't ever be in a position where you have to trade on a big day. A big day in which you have to trade. Now, we may want to trade because we're making all this money and we want to realize that. That's wanting to trade. Having to trade is when you're being forced to trade because you are losing and are going to be pushed out of your positions. And for me, the times if you have to trade, and it's when you're the way you're set up in your investing is that you're going to have to trade on a very bad day for markets. You're setting yourself up to fail. And so I just wouldn't ever put myself in a position where I'm going to be forced out of a trade in the worst possible time to be forced out of it. I just wouldn't take that risk. And so the point being, always position yourself so that you can withstand difficult markets. If you were forced out on Monday, you're looking really foolish today. So don't put yourself in a position to be forced out on Monday.
So you don't see anything in terms of like a systemic risk to the market. Like if everybody's trying to get out the door on the same day and something major happens, that we have, much less liquidity behind the scenes for them to do that than we've had in the past.
There's never enough liquidity when everyone wants to go out the door. There never is. There never will be. There never is. That, when the world turns in such a way that everyone needs to get out, are you going to be the opposite side of that? I'm not.
Yeah, definitely not.
Right. That's the problem with crowded trades, and that's the problem with markets in general, which is when things radically change, the price is going to change. You're not going to get out before the price changes. You may think you are going to get out before the price changes, but the people that are on the other side of that are not stupid. So that's not what I consider liquidity. I consider liquidity is all the information is out and now you just want to transact. Can you transact at a fair bid offer spread? And the chances are no during times of uncertainty. And so I wouldn't put myself in the position to do that. Now, that's not going to protect you when everybody decides they need to sell something. It's just not going to do it. You're not going to beat anybody to the market, and the market's going to move whether there's a transaction or not. I just consider that different than liquidity, maybe.
Well, that makes sense. Yeah, for the second half, I want to switch to the economy because last time we talked to you was April 30th on our live stream, and I believe your boat was out at sea. You were resisting soft landing island. You weren't sure where you're going to go. Can you just update us on where you are now?
Yeah, it's still unclear to me. I think what happened, I think, sometime in June, maybe, or or late June, early June, is we started getting weak data. Inflation data had been coming down. It continued to come down and wasn't as hot as it had been in the early part of the year. That gave, that was good. That good for markets, good for the economy, et cetera. But we started getting weak growth numbers. And that by and large has continued. There's been some good numbers and some bad numbers. The most recent number was last Friday, which caught the market, Friday before last, which caught the market and long and caused a sell-off, which then followed through on Monday, was the NFP, which was soft. And so the economy is heading toward some sort of landing. And I'm not sure what kind it'll be. And I'm not sure that inflation is necessarily going to allow the Fed and policymakers in general to cut as much as they would in the face of a weakening economy. But, and I think this is the most important thing, for months now, we've been focusing on the second decimal place of inflation data. It's not important whether, it comes in at consensus of 0.2 or not. It matters if it's 0.18 rounded to 0.2 or 0.22 rounded to 0.2, up or down. That tells you that people are done talking about inflation. So we have CPI on Wednesday and PPI tomorrow. I think that the narrative around inflation has shifted to it's not a big deal anymore. Now, that could possibly have consequences, but the more important thing is what's been put in its place, and that is weakening jobs, because the Fed's mandate is a jobs, full employment and stable prices. And they've told us that certainly Powell has told us, but many other on the dovish side Fed members have told us that, they're balanced. They see the economy is balanced and there are risks to the downside regarding jobs, and they are paying a lot of attention to the employment situation. Now, that seems right. That seems to be the thing that could be next. And so how's the market reacted? The market's reacted to immediately pricing in 50% chance of a 50 basis point cut in September, and a total of 125 basis points cuts in 2024, which the Fed, based on data they had in June, was saying there was only going to be a single cut. So the market has headed to recession island. It's on island. And so I don't know what to expect, but yet equity prices haven't really corrected much. So I don't know what to expect for my outlook for the economy is it's probably not as bad as people are pricing in terms of the fixed income market. There is a reasonable possibility that inflation continuing to go down won't move markets, but inflation bouncing will, in a negative sense, to bond market. And so I'm worried about a hot inflation print. And for that matter, I'm worried about not worried, I think it'll be good, that the economy will be stronger than people are pricing. And so that's how I'm positioning, which is 2-year notes anticipate a recession, a significant cutting cycle, and stocks anticipate a soft landing. And there's still a possibility that inflation isn't dead. And so to me, being short both stocks and 2-year notes is the best risk reward at this stage. Whether we're in the midst of the deleveraging, whether the deleveraging is done, whatever, that seems to be the best bet.
Yeah, we seem to have been trapped in this cycle where, we get bad news, they price in more cuts, things get a little bit better, and then the cuts go away. It seems like this just keeps happening over and over again.
Yeah, I mean, it's unclear to me whether, so 10-year notes are below 4%. They were at 5% on Halloween. They rallied from 5 to 4. Then they moved from 4 to 4.8, and now they're back to 4. Okay, that has an impact on the economy that doesn't lag very much. And so part of the reason why I'm more optimistic short term on the economy and why I don't think we're heading to an imminent recession is the easing that has occurred. Mortgage rates, I saw mortgage rates broke 6%. Some form of mortgage broke 6% today. That's going to unlock some housing activity, I suspect. So, I'm not willing to say that we're heading to a recession, and I'm certainly not willing to trade based on it, because except for being short stocks, there's no opportunity in the bond market, in the treasury market, to bet on a recession. It's already priced.
Did you think there was an overreaction to that jobs report? It seemed like some of the stuff might have been temporary. Do you think the market maybe priced too much in after that?
So I think the big point is that we're in the midst of a deleveraging, and positioning was offsides for a world that could either be recessionary on the stock side. And what happens in a deleveraging is people who are long stocks and say, I don't want to be long stocks anymore, whether they're leveraged or not, have to sell and have to buy something. They can't just say, well, I'm going to take bills, like literal money, hard money to as receipt, or I'm going to either take a bank deposit, or I'm going to buy bills, or I'm going to buy 2-year notes. I'm going to buy something. And so I think the squeeze on the front end was entirely people just rushing to cash, not having not caring so much about what they were pricing in. Like, think about real dudes who are selling their stocks and need something to put it in. Are they really focusing on the dime they should save that would price the 2-year note more like the appropriate Fed path? Or are they saying, just give me the 2-year note? It's, it doesn't matter to me what price I buy it at. I'm just going to buy it. And so I think there was a completely inelastic bid for short-term interest rates that, those who bet on the Fed's path in a leveraged way are saying, fine, if you want to pay up, great. They've begun selling, and it's now come back in a little bit, but the market is in the deleveraging, and you're going to still continue to see demand for 2-year notes, even if they're 50 basis points wrong in price, because 50 basis points wrong is nothing when you're thinking about getting out of a stock that's down 10%.
Going back to inflation, one of the things I've learned from you, which I think is really great, is your script for killing inflation and how that process will work out. Can you just talk about what that script is and maybe where we are in it right now?
Yeah, so my expectation was, and so far it hasn't played out as I expected. When I wrote that, it was over a year ago, and it was into what I thought needed to happen. And what I thought needed to happen is that long-term interest rates, the curve needed to bear steepen. Now, it turned out it did for 3 months, and equities started to fall. And I was fairly confident that we were going to kill inflation. The way you kill inflation is asset prices fall enough so that you no longer have cheap financing for corporations to build, for homeowners to buy new homes, for consumers to spend cash when they can, borrow to consume. And people's wealth is down because all asset prices have fallen. That tends to kill demand. And we were on that path leading into Halloween. And at that point, both the Treasury and the Fed got very concerned about the bond market sell-off and the data that had started to be impacted by these higher rates, and pivoted. And so the script was thrown back to day one, where it was unclear when the recession would come, when inflation would be dead, when demand would decline. And I'm still not sure it's there. I look at financial conditions, they are very easy, which should support the economy and keep inflation sticky. But I might be wrong. And so what I'm looking for is to know that the script has not yet played out and inflation is not dead. I need to see inflation not being dead yet. And so that's what it could be over. Inflation could be over. I don't think it is, but if it is, that's very bearish for the economy. And in particular, very bearish for the stock market. Not so bearish for the economy. Sorry, I misspoke. Fine for the economy, but bearish for the stock market because they've been counting on significant nominal growth. And without inflation and with slow growth, you don't get the sort of earnings expectations that are built into stock prices.
This is one of the things I've learned talking to you and to other people we've had in the podcast, is this idea of the importance of thinking in probabilities. You're not saying inflation, people want to say inflation's dead or we have a recession tomorrow. Like, so much of this is just probabilities of what might happen and, trying to figure those out and try to figure out what the most likely probabilities are and then positioning for that.
Right. And the best part about it is the market tells you what they think the probability is. And so when you trade, you're, in a market timing alpha sort of way, betting sort of way, you get the market odds and you compare them to what you think the real odds are. If you're investing in any other way, how are you thinking about your investment? The market is telling you the odds of various outcomes in its price. And either you have to bet that someone else is going to make the bet you're betting at worse odds, meaning the price you got in is good and they're going to pay you a higher price and you're going to get out, or the odds of the thing that you're betting on is higher than the market's paying. And to me, that's what investing is about.
And when you think about the islands in that framework, I mean, do you think about like the probabilities of each we've got the soft landing island, we've got higher for longer island, we've got recession island. Do you think of those being fairly equal right now? Or do you think one is the leading candidate?
So again, what I think versus what's priced in. What's priced in is essentially a zero probability of significant rate hikes because inflation isn't dead. That would be, or even a long pause. We're expecting 200 basis points of cuts in the next 12 months. There's nothing priced for higher for longer. So the probability is zero. I think it's higher than zero. Recession, I think we're priced at about a 50% odds of a recession imminently. Maybe it's not that high. Maybe it's 35, 40, but high, imminent recession. And I think the odds of that are much lower. What's the number? I don't know, 20, 25%. That leaves the soft landing. And I think I know these probabilities won't add up. I don't think there's a chance that we end up having a soft landing. So the way I think about it is market pricing may stay at a soft landing until it deviates. And so betting against a soft landing is a pretty high odds bet. But, the market's really placing a high probability of a soft landing in its pricing. I think that probability is very low and will look like a soft landing until it's not.
Or we talk about the Fed and what's priced in terms of what they might do. I'm just wondering what you think they should do. Like if you were in their position right now, it seems like the data is a little bit uncertain as to what we're seeing. There's been significant rate hikes over time. I mean, is there a case to be made to try to slowly bring things back down to minimize the risk of recession? Or how do you think about that?
Yeah, I mean, I think it's what they should do. What they should do is look at the data and think about it in an appropriate way. And I think mostly they do that. What I think they should do is pay a bit more attention than what they do pay attention to. And that is the effect of long-term interest rates versus the short-term interest rate mechanism. And so that's what I think they should do. They should pay attention to the potential that low long-term interest rates makes a big difference, and high long-term interest rates makes a big difference to the economy. Whereas in this economy, where bank deposits are sticky and don't respond to big shifts in the front end, and in which most borrowing is done longer term, and in which most private sector borrowers are flush with money from wages or asset appreciation. At a macro sense, obviously, some people are having very difficult times. Short-term rates just don't matter much, and I think they overemphasize that. So that's what I think they should do, and then they should focus on the data. But so they will focus on the data, and we'll see how it plays out. We've got a couple of CPIs and an NFP between now and the next Fed meeting. We have Jackson Hole. We'll see what they do, but I would like to see them focus more on the influence on the economy of long-term interest rates. And then if they begin to see that that's an important factor, take policy steps to address that factor.
So that would mean more QT, right? Than playing around with short-term interest rates.
Well, I actually think there are two things that let me just say exactly what I think they should do. I think they should stop reinvesting the proceeds of their balance sheet runoff in anything but bills, which means they stop adding on 10 years, stop adding on 30 years. And that would force the Treasury, presuming they still want to sell as many 10s and 30s, to sell more to the private sector, which would have an influence on this curve that is still that would disinvert the curve. It wouldn't have any impact on reserves because that's reinvestment. And then to the extent that it's not working and inflation stays sticky, at that point they could, and this is not QT, it's what we call a twist. They could, because QT reduces bank reserves, and, bank reserves are still very ample, but they could get, over the next year, they will get tight. And in order to continue to wind down their balance sheet and affect long-term interest rates, the Fed could sell some of their long-term bonds, and particularly their mortgages, which they've said they don't want to own, and reinvest the proceeds in bills. And if they were to do that, that would have no impact on bank reserves. So those are a couple of ideas. It's essentially reducing the duration of the Treasury of the Fed without cutting reserves. And that's what I think they should do. Will they do it? They don't believe that the long end, they are unwilling, except for 1 month in October, to even acknowledge the impact of long-term interest rates on the economy.
When you think about inflation long-term, outside of this episode we're dealing with right now, like, how do you think about that now? Like, I think, from my own perspective, coming into this, before we had any inflation, I was thinking about, technology and demographics and globalization as these trends that were putting downward pressure on inflation. But I assume that world is over, and globalization is definitely going the other way. So how do you think about where inflation goes longer term?
I think of it the same way. My framework for inflation is pretty straightforward. It comes in from three different places: supply of goods and services, demand for goods and services, and what I call monetary inflation, which is the creation of money and credit. And the last one, when money and credit is created, that is and handed to the economy, that is generally inflationary, because there's more money to buy the same amount of goods and services. So the price goes up. Then there's demand, which to me is, you mentioned demographics. That's certainly one thing. But that can shift based on taste. Certain economies are profligate spenders and other economies are spendthrift. Spendthrift, is that I think that might be the wrong usage.
I think so.
Anyway, cheap, don't want to spend their money. Japan is a good example of an economy that is just savers. They're just savers by nature. Now, you add in the government as a spender, and you can get demand side inflation, which just people decide to dissave and spend. And then there's the supply side, which is, how much output can the humans and their machines generate? And in globalization and automation, you had an environment where people that were not productive were able to make socks, and that created a huge benefit for the sock industry, and socks got cheap and deflated because we got all our socks from China. A lot of that is played through. And so now you're in a world in which we have allies that we can't, and this is the deglobalization idea, and I don't think it's actually happening much, but at any point in time, we could have a deglobalization supply chain constraint, and that can be inflationary. But I think the thing that we're not discussing is obviously AI, which has the potential of reducing the amount of humans you need to create the same amount of output, or increasing the amount of output for the same number of humans and the same costs. That's deflationary. So, I just look at each of those things and say, the future could be one in which AI productivity creates a strong enough anti-inflationary force on the supply side, despite money creation inflation and despite government spending. We could see aggregate disinflation or low inflation. But right now, we're not getting any of that productivity. And so I don't see the supply side disinflationary impulse as being very long lasting at this stage.
Yeah, AI is something I have a hard time thinking about because I think back to the internet when it first came and then what it ended up being relative to what I thought it might be. And they're obviously very different things. And it's going to be the same thing here with AI. Like, I don't think any of us understand exactly what it's going to be, but trying to think about that in terms of inflation, I think is a tough thing to do because we just don't know at this point. It's obviously, I don't know if you've used it a lot. I've used it a lot. It's a pretty incredible technology, but what it means for the economy, I have no idea.
Yeah. I mean, I've been using computers to do analysis systematically for many decades. And this is a leveling up of that sort of thing and part of that is the compute power has leveled up. I have no idea. I have no idea what the 5-year impact on disinflation and productivity will be. I do know that there is a tremendous amount of money being spent, which is inflationary today, on chips, on servers, on racks, on everything on people who can help in the development of AI. So wages for certain people. And that's creating an inflationary pulse without yet with no productivity increase of any meaning. And so I just look at it for now. We can I'm not a futurist, though I love engaging in futurism and thinking about what the future could be. I don't place any value at all in them for either my accuracy and certainly not for my investment strategies.
I'm just curious, are you finding like in your everyday life or in your business that you're using things like ChatGPT a lot?
Not really. I've tested them all. I've tested Claude, ChatGPT, Perplexity, half a dozen others. And, to me, the large language model is not a particularly interesting usage of what I do usage for productivity enhancement. And like a lot of things that I've seen, they look pretty damn cool for people who are not subject matter experts. And subject matter experts are like, holy moly, these things are so wrong so often that they're essentially useless for a subject matter expert.
Yeah, I found like like you said, I mean, stuff like that, it probably does not work. But day-to-day stuff, like for instance, the summary of this podcast for YouTube will be done by Claude because Claude does a really good job of it, actually. And then I make some minor changes, or like the timestamps on YouTube can be done by Claude. So those aren't things that are going to revolutionize the economy, but they are things that took me a bunch of time before. And these things are getting better and better and better at doing that.
I think
So
that is fantastic. I even like the movie stuff, the deep fakes and the creative stuff. What was the thing that OpenAI created? Anyway, Ergo? No, I don't remember. Anyway, the thing that makes videos, I think the creative, let me just say this. I think you would have I think you still do a better job than than Claude does in summarizing this episode.
I think that's right. Yeah, so I still have to tweak it a little bit, but it's relative to and I could probably do the timestamps a little bit better too, but relative to, it can get me 90% of the way there. I think that's when you put the human together with it, I think that's probably where it's at its best
I
right
agree
now.
with that completely.
Because if I put those,
I don't use it because I can't afford to have mistakes in that type of stuff. But
if I go put a summary of your podcast up there and it makes up some place you worked in the past, I can't let that be in there. So
Right.
Obviously I still have to read all of this stuff and I have to supplement all of this stuff, but it probably reduces the work by, 80%.
That's huge.
Of doing those things. So from that perspective, it's an advantage.
Yep, absolutely.
Just one more. You've been very generous giving us an hour of your time here. I just wanted to ask you one more because it was going on Twitter recently. I wanted to ask you about market analogs because we see this a lot. We see people looking at certain periods in the market in the past and saying, what can I learn from that? And obviously at the extreme, people say it's just going to repeat itself, which isn't right. But it's more on the other side of what can I learn from this? What can I take from this? And one of the ones we saw recently was this 1998 example. And I was wondering if you could talk about that a little bit. How do you think there's a comparison in 1998 with what we're seeing right now? Do you think there's something we can learn from that?
So I use history to build frameworks. What mattered to things that are generally common? I gave you my framework for deleveraging. And the way you come up with that framework is you say, what mattered? And, how does each one of these examples differ and in what way? And that creates a framework. And then you can, so once you have a framework, that's about as much as you can draw from it. You can think about what happened and why and how things are similar and different. But, things like fractals and charts that look the same, I don't get much value out of that. And the statistical probability of any analog being predictive of a future is very low. So I like to just say, we don't know anything, and the markets and the economy will definitely behave differently. But, what is going on? What is going on? And in 1998, what was going on was a large hedge fund unwinding, other hedge funds having similar positions, unwinding, some of them unwinding early before LTCM did, some still in the midst of drawdowns from 1997's currency issues in Asia, and others very recently in the midst of drawdowns in Russia. And so, but one poster child who had the biggest, most leveraged positions unwinding. And when that happens, certain deleveraging things occur, including typically an equity drawdown. And so we saw that. And then, was it impactful to the economy? Almost zero. In no way was it impactful to the economy. So from my framework there, it didn't require central bank action. And yet the central bank took aggressive action, including a surprise cut and a total of 75 basis points of cuts, and arranged the bailout of LTCM, forcing 14 banks to pony up $3.5 billion. And that was a fairly at the time was a very forceful reaction. And I think the consequence was that the drawdown was relatively short, and the impact on the economy was actually pretty long lasting, in that they probably overstimulated and contributed to what was happening in the next 2 years. So similarly, so what's the similarities and differences? I don't see any similarities to today. Pretty much across the board. Unless there's some whale that's getting killed in the last few weeks that is very concentrated and needs to be bailed out, and has positions that are, and banks have positions that are similar. There's just nothing like that going on. And yet, if the central banks, if Japan really does decide to let monetary policy go on pause despite data that gets hot, which I don't think they will, but if they were to, and the U.S. cut 50 basis points for each meeting for the next 3 meetings, yeah, equity markets are going to rip, gold's going to rip, bonds aren't going to do great, but, they're going to be dragged down by the front end. And it's going to be an asset rally. So, I don't think the Fed will do any of those things. I don't think any central bank will react to what's happened in the last few weeks. But that's the thing to look for. You look for, was the problem taken care of? Check. Was the problem systemic? A little bit, but, mostly it was taken care of. And how strong was the response despite an economy that had that had no effect? Very high. And if you look at 98 and you see that the actions are similar to what the actions of central banks were in 98, you know what to do. We're going into a hyper bubble.
Well, Andy, thank you. This has been awesome. If people want to find out more about you and DampedSpring, where can they go?
DampedSpring.com and on Twitter.
Great. Thank you so much. I really appreciate it.
All right, Jack. Anytime.
This is Justin again. Thanks so much for tuning into this episode of Excess Returns. You can follow Jack on Twitter at @PracticalQuant and follow me on Twitter at @JJCarbonneau. If you found this discussion interesting and valuable, please subscribe in either iTunes or on YouTube, or leave a review or a comment. We appreciate it.